are a key aspect of technical analysis, as they allow us to identify patterns that can lead to many successful trades. These levels are determined by a security whose values touch multiple points without breaking through them. And don't worry, we'll go into that in just a second. Now, the more time an asset has proved unsuccessful in breaking certain price levels, the more validity its support or resistance level holds. So let's take a look at this chart of the Great British Pound and the Japanese Yen. Here, we can very clearly see that our support and resistance levels are keeping the asset's value within a certain parameter, around between 187.105 and 188.503. So, support is basically a psychological level where the demand of an asset is regarded as strong enough to keep the asset's price up. The demand for the asset becomes much greater when it hits the support line, and it generally bounces back up in value. As I mentioned earlier, a healthy support line hits multiple points on the chart, and that's what this means. It means you can see shadows from many different candlesticks touching those points. Resistance is specific. If the value of the asset gets to a certain high value, it becomes less in demand and is generally pushed down from there. Again, a healthy resistance line hits multiple points on the chart. The more times a line hits points on the chart, the stronger that line becomes, and that price level becomes more concrete and defined. So an easy way to think about these two is to think about a floor and a ceiling. The floor keeps things within the room, let's say, nothing gets below the floor. The ceiling keeps things inside, so nothing can float up through the sky. Now, while these two are opposites in definition, support and resistance can actually be regarded as one and the same. Think about this. If an asset value breaks through the resistance line, then the resistance becomes the support line, and a new resistance value is then established as time passes. So it might make it easier to think about yourself sitting inside of a building with many different levels. Right now you're on the first level, you have a floor underneath you, you have a ceiling above you. So what happens if you break through the ceiling onto the second floor? So now that ceiling has become your new floor, and your new ceiling is there above you. The same goes for the opposite, of course. If the value of an asset breaks through the support line, then that line becomes the resistance, and a new support line is established. So in this scenario, you can think of yourself as being on the very top floor. You break through the floor, and you fall onto the floor beneath you. So suddenly, your floor became the new ceiling. Now, when a support or resistance line is broken through by the asset's value, it basically means that the perception of the asset has changed. It's now regarded differently. Essentially, the demand has changed. And that's exactly what support and resistance levels are. They're essentially a way for us to visualize support and demand. See if there's a lot of support, if there's less demand, and what can be done about that. Now, if you guys are having any kind of audio issues or technical issues with the screen share, there's really not too much I can do. The only thing I suggest is that you sign out of the webinar room and then sign back in. That generally fixes most little bugs that might affect the presentation. Otherwise, it could be that your internet connection is a little slow or a little faulty, but beyond this, there's really not too much I can do. Now, in the example that I showed earlier, we saw that support and resistance levels are in a straight line, and 99% of the time they are, but they actually don't have to be completely horizontal like that. They can be elevated at different angles as well. And when these lines are angled, they are referred to as supporting or resisting trend lines. And this brings us to our next subject.